For those that have been, we talked a lot about, for those that follow us, that we've been talking a lot about the OSPs with that big increase in Saudi Arabia. And so we wanted to leave them here just so you can kind of get it in terms of connections back to Iraq. Because one of the things that we were saying, it's going to be important to look at where is Iraq right now versus Saudi, in terms of some of the flows, especially when you compare it apples to apples, looking at heavy and medium. And you can see that, medium is still and heavy is still well priced to move versus Asia, versus US, versus Europe when you look at the comparison. And it's important to put that into context because Iraq is, again, they're going to be able to move product. Then when you look at Murbain, which set their price at about just over $75. Again, those are ways that they're going to continue to kind of compete against and move product away from Saudi Arabia when you look at some of the different adjustments. And I think that's a really important piece when you share that, when you look at the two between like, okay, well, we haven't gotten Kuwait yet. Kuwait will likely follow something similar to Saudi. But Iraq and at least the Murbain crudes will find some of this ability to move some of this product. And that's going to be an interesting pivot because, as we said, some Chinese buyers have said that they're not going to take their full term from Saudi. Some will, but they could go out and say, look, we're actually not going to even go out and try to replace what we're not taking from Saudi because we have enough in storage, enough in floating storage, or you know what? Let's go see what Iraq is going to give us. Let's see what we can get from Nigeria. Is there anything from Angola left over? Anything from Congo? And try to piece it together instead of dealing with Saudi. And I think that's going to be an important piece. Now, I'm sure you've seen all the headlines flying around that Urals is now over the cap. So when you look at the, and it's funny because it's now just hitting it, but it was this morning, Urals in the north and out of Novo are assessed at $60.32 FOB or free on board. And compared to Arab Light, which is assessed at $82. So again, if you're a Chinese buyer and you're like, okay, well, I can go to Saudi and pay $82, or I can go to Urals and pay $60.32. It doesn't take a mathematician to know which one you're going to opt for. So Chinese buyers are lowering demand for Saudi crude. 22 is a lot more in the freight, which is, a difference when you consider freight. It could be anywhere between $8 and $9. So ESPO is over 70. It's been over 70, but cheaper shipping. You're coming, ESPO is essentially, north of China coming back down. So again, it's cheaper shipping, so you get a bigger price, but they've been buying them the whole time. Again, this $60 nonsense hasn't stopped anyone. So several cargoes of ESPO crude for August arrival were purchased by Chinese teapots at a discount of $4 to $4.50 to ICE Brent prices on a delivery basis to Shandong. And again, so if you think about ICE Brent, where obviously it's gone back up, but that's why, again, ESPO over 70, they're paying almost $75 for ESPO, which is still cheaper than what they would pay elsewhere. China's Unipec also bought some ESP cargoes for August. Again, discounts for Russia's ESPO cargoes to China have shrunk, with many shipments for July traded at a $5 to $6 discount, and now trading at a $4 to $4.50 discount. So again, it's just because Saudi has essentially said that, well, I'm going to raise OSPs. So Chinese buyers have said, okay, well, I'm going to go buy more ESPO. So there's a bit more of competition, drive some of those prices higher. So again, Saudi is just benefiting the Russian backdrop when you look at some of these different flows. And then you could look at it and say, well, based on Asia, so Asia can go get Basrah Heavy for $265 below Oman, Dubai. And when you look at Saudi's charging $1 premium. So again, you're getting some of these differentiating factors where it's like, well, why am I going to go to Saudi if I can go get this from Russia? I can go get this from Iran. I can go get this from Iraq. I'm not going to opt for that Saudi flow. And this just puts it into perspective. Iraqi Basrah Heavy crude oil selling prices to Asia, they're right where it was in 2018. When you look at premiums, You're not seeing too much. They're cheaper versus where it was in 22, 21, 19, 20. So again, you're seeing some of this pricing action where it's like, well, don't buy from Saudi, buy from us. And again, these are some key pieces to see. When you look at Iraq Basrah Heavy to the U.S., you can still see that it's well below where it has been previously. Again, trying to, and this is going to be a benefit for what the U.S. is going to try to pull down. And then when you look at it to Europe, Europe has gone up. There's a lot of reasons why Europe isn't a huge buyer of heavy, just because of the way that their refiners are structured. CPC flows have come down. We still haven't had the turn on of CN. So you're seeing the med getting a bit tighter, which is why, even though I talk about the U.S. exports for crude coming down, we still have a pretty good export market into Europe at this point in time, which is why when I say it comes down, it's just we're going to lose a bit of that swing going into Asia, but we'll maintain some of that flow going, or I should say most of that flow going into Europe. Middle Eastern floating storage has come down. A lot of this is just because of that glut that's being cleared from Saudi going in the Red Sea going into Egypt. So they're back to where we were in 2021. It's going to be interesting to see as more countries opt out of some of the flows, opt into maybe Iraqi, UAE. Does it stay at this lower end? Do we get a bit of a bounce? But again, this is going to be an important data point to watch as we go forward. Western Canadian Select differential right now $11.30. You can see it's still at the higher end of the range. The question is going to be is it at a point now where it starts to price itself out based on some of the crack spreads that we've seen in pad 2? They still need flow. It's still there. It's not like they're going to go on the water and get anything much cheaper. So instead of seeing a big drop, it's likely they're going to try to balance it out and show a bit of this sideways move and just hold what we think at this elevated level, which is going to put that bigger kind of pressure on cracks. So now when we look at naphtha versus fuel oil, it's important to understand that typically heavy naphtha at this point in time, light naphtha, you're really not going into the petchem stream. That's really going into the octane stream. And one of the things that we've talked about is just how much of a glut there is on the gasoline front. And that's what's really starting to kind of push this and pull down some of this levels. There's a lot of naphtha out there. There's a lot of condi, a lot of it coming from the U.S. But fuel oil, like when you think about the fuel oil on a recracking side on a blending basis, you have some of that demand and you don't have the availability because you're missing that heavy crude. Without that heavy crude, you're not creating the same heavy slate that you have been previously, but you do have a lot of light sweet out there. So you're creating a lot of the top end, the lighter side, but you're not creating a lot of the heavy, the bottom. So if you think about the top of the stack and bottom of the stack, you're going heavy on top, but you're going light at the bottom, and that's creating these imbalances, which is why we're seeing pricing for heavy mediums ramping up and you're starting to see some of that flip, which is what we had been highlighting previously. When you look at Indian oil demand, it's remaining strong. When you look at inflation went up for India on the CPI level. You're still seeing some of these pressure points. And as crude prices go back up, that hits India pretty hard, pretty quickly. So that's why we're going to want to look at, well, what does that do to the economics of it? They're still benefiting from Russia, paying $22 cheaper than what they would buy from Saudi. So again, they're still going to see some of those flows coming through. Now, Asia's, when you look at the plastic profits, it's naphtha ethylene margin, naphtha propylene margin. This is why we were talking about a lot of naphtha is not getting into some of these markets just because you're seeing that pressure point. You're seeing a lot of that demand for ethane and propane. But as the plastic markets cools, that's going to, again, pull down that ethane propane side. And that's where you're going to see some of these different movements. And the reason why it's so important is because, as we've been saying since 2014, for those that have known me that long, China, made in China 2025, They sanctioned a lot of building and refining, a lot of building and petchem, and that's where you're going to see some of these additional flows, which is why they matter so much, why we had support for LPG exports from the U.S., why we have support for ethane exports from the U.S., and it's important to appreciate that if you're running an ethane cracker, it has to be a minimum of 87% ethane, which means that at a minimum, you're running 87, you're pretty close to 92, 93%. So you're beholden to the ethane market. Propane, you have a bit more fungibility between propane, butane, some naphtha. But if you're running a naphtha cracker, you can run the gambit even a bit more. So here, when you look at what's been built, you took advantage of the cheapest molecule. The cheapest molecule was LPG and ethane. So you weren't building naphtha crackers in Asia. And if you were building a naphtha cracker, you were building it as a cohort with the refining, but with flexibility of the light end versus some of the NGL side, which is why we're seeing some of these additional flows. And as you get a lot of condi, a lot of NGLs getting pushed into the market, you're starting to see some of that pressure point. And then the naphtha side, pressure is increasing because of the gasoline front. There's a lot of gasoline in the market. And then on the NGL side, that pressure is going to continue to build as the petchem continues to fall under pressure. This just gives you an idea of projects that are continuing to be built in terms of ethylene. And there's a lot of it, and it's all coming on, as you can see in the China, mostly in the Chinese markets. So when you look at U.S. exports of crude, you're seeing it come down just a bit. Again, we see that just trending a bit lower on that 4-week rolling average, something closer to 3.7, 3.8 over the near term. Cracks, again, rebounded, as we've been talking about in the Asian markets. A lot of that, it was just driven based on the increase in some of the prices for their crude. But it's just you're still seeing some of that arbitrage, but there's still some flattish demand with some weakness coming through, especially when you look at, you're in the monsoon season for India. This is going to be an interesting one because you could get some divergence between the U.S. and, or I should say Gulf of Mexico and the Asian gas oil spreads. And this could, not to say it's going to collapse, but you could see this come back down and that could accelerate, and it's what's going to be the big driver on it. What does China do with their export quota? How much of that ends up in the market, and does that weigh on, build up some of that storage, push down some of these underlying crack spreads? When you look at Dubai versus Brent, you're seeing that it's back to 19-cent spread, still on the lower end. You had ADNOC set August Lulu crude at 15-cent premium to Murbain. Murbain crude set at that 75.61. Upper Zaychem at a 60-cent discount to Murbain. So again, you're seeing it at around $75, which should help move some of this crude in general, especially as a lot of that European availability, Norwegian availability has been absorbed, which we'll talk about in a minute. Middle East Murbain, as we were talking about, retroactive the OSPs, we're right at about 2018 levels. Not too much movement one way or the other. We don't see too much of a shift here. You could see we're below where we were in 17 and in 22. And that's going to be an important one to watch because, again, that competition between UAE versus Saudi. Asian floating storage moved back to the 2023 highs. We did see a sizable drop in Chinese imports, or what is being flagged for China, which is, again, normal for this time of year. But at the same time, they also they were front running some of their import quotas, which is why you're seeing some of this left on the water. The question's going to be, do they get a little bit more import quotas? Does some of this kind of sit out there for a little bit longer? And this is going to be an interesting one to watch because we were thinking it was going to follow a little bit closer to 2022 levels. Instead, it's following a bit closer to 21. And this is going to be that big pivot on what does China do, because at this point, China can make or break the market where you had some of the product coming out, you had some of this pricing pressure coming through, and China could say, well, we're not buying at these prices. And if they don't show up, which they typically don't in the July months, that could put, again, some of that cap. So That's a long way of saying, because if you remember, we were thinking that the trading range was 73, to 77, on extension 72 to 78. And right now with Brent at about 80.25, obviously it's above our 78 target, but we're not ready to say, oh, no, it's reset higher. This is what gives us pause when you look at some of these shifts and some of what is happening out there. And yes, the differentials have tightened a bit, but is that going to be enough to bring down, to get some of these Brent contracts up? Because remember, Brent is light sweet, and you're not, or at least at the higher medium side, and the shortages is at the heavy front. So you're really not reflecting the same thing between the two. So if you can, I'd buy the heavier side, not the lighter side, if you can play on some of the spread bases. So again, that's why I don't see the same level of growth. Could we kind of reset this up and say that the new trading range is 74, 75 to 80? Sure, I'm not against it. There's not enough for me to say 78 is no longer the top. I think it's going to come down to where some of the movements are through July based on some of the Chinese data. And here's what we're talking about. You've had that sizable drop in crude imports. You're still, again, well above where you were in well above where you normally are, obviously below 2020, but you normally get these drops and come into the low end as you get into the back half of July. But because they were running so hot for so long, they have a lot in floating storage. They have a lot in onshore storage. Their state-owned guys are operating at 78% utilization rates, which is about 5% lower than normal. You have their teapots only operating at 62, 63%. They should be at 68%. So the refiners really aren't operating at a higher level. So you could see, we think that you're going to see a bit more pressure to the downside because they're going to say, well, there's no impetus for us to buy additional given where spreads are, where prices are. We'll pull from inventory that we've been buying at a steep discount and feed the beast that way. They've continued to show contraction in the industrial, the manufacturing side. The consumers leveled off a bit. So you're not seeing the same demand internally for product. So why go out and continue to build up storage at these price levels? Why not wait a bit in general? So then when we look at the activity, as we said, this one hasn't been updated yet. We'll get an update, likely next week, where the congestion, it's going to outperform 22 because if you remember, they had another lockdown as you got into the end of summer. In some areas, obviously. So we don't see this, we won't see the same drop, but again, we're not going to see this level of activity. Now, it's interesting because West Africa crude floating storage is at a new seasonally adjusted all-time high. It's above 2022 levels. Again, it's a crude quality problem. Do they have the availability of qualities that's needed? Did they price themselves out of the market? Do they have to bring things back down? Because remember, and we'll talk about it in a minute, West Africa actually increased some of their increased some of their pricing. And people could say, look, I need the crude. I'm not paying that price. So again, if you remember, the West African nations could be saying, look, we're seeing some tightness. Let's try to take advantage of it. They raise prices, and then typically they slowly take them down to find where is that clearing price going forward. So when we look at crude exports, gasoline had an increase of 253,000 barrels a day. The 5-year average is 296,000 barrels a day. So again, you're seeing that balancing act that PADD 3 continues to do. Distillate was increased 198,000 barrels a day. The 5-year average came in at about 196,000. Above 196, up by 196,000. And a lot of times, that's, again, that balancing act in terms of you have an increase in utilization rates that's going to throw off more gasoline, more disti. So now it's a matter of how do they kind of manage that going forward. Propane had an increase of 362,000 barrels. That's 395,000 above the 5-year. we're still priced to move. You still have less LPG coming out of Saudi. You still have less capacity coming out of Kazakhstan. CPC's taking volumes down again. So you're getting some of those benefits in general. Again, these are going to be important pieces going forward, which I think are going to be interesting to see in general. But as we start to get into the end of August, September, we do see some of that pressure coming into the LPG market, especially because remember, you have the Saudi that maintain their cuts by 1 million barrels in July and August. And if they start to bring them back in September, well, that's going to bring back LPG into a market that is oversupplied on the plastic side, oversupplied on the NGL side, and then that will start to pull some of that down. Crude oil exports, obviously bounce back and forth, but you're seeing that the top end is coming down. We still are comfortable saying about 3.7, 3.8 million barrels a day of flow. Here you can see gasoline. We've had a spike before. We normally have a spike now. The question is, where are we from here? And we think that we're just going to stay at the top end of the range, and not fall below the 5-year as they try to, again, balance that market in general. Distillate, had a nice bounce. This is going to come down to east-west Suez. Where is the ARB? The ARB going east to west is closed, which is going to be supportive of the U.S. because then Europe needs product. They're going to turn around, buy it from the U.S. because it's cheaper to buy it from the U.S. versus buying it from the Middle East and from Asia. And that's why this is all going to be derived from where is the ARB. If the ARB closes, you're going to get more purchasing. If the ARB opens up, you'll see U.S. exports drop. And that's going to be that balancing act as we see kind of where things sit. I think as Chinese exports hit Singapore and you have that kind of domino effect, that'll open that ARB up a bit more and, again, push some of these exports down. But just based on what we're seeing right now, there's support for our distillate exports over the next few weeks. Crude oil exports, as you can see, a bit lumpy, but still going to stay at the higher end. Propane, propylene, it's still going to set a seasonally adjusted record, but you're just not going to, the pressure is going to start to eat into us as we go through and into September. Ethane exports, had a nice bounce. It's always going to be lumpy. The benefit for us is the additional ethane crackers because, again, you're beholden to ethane. So as those crackers come on, even if it doesn't make sense, you have to buy ethane, you have to run ethane, and that'll help keep our exports elevated, even if we do see some of that pressure on the pricing front. Total oil products, when you look at Fujairah, there was a small build of 46,000 barrels. The week-on-week rise, again, it's still above 20 million. Light distillate was the driver. It increased 1.43 million. As we said last week, that was where we saw some of those increases. East of Suez gasoline complex was fairly balanced as the Indian gasoline demand started to slow down. We don't see that changing. Egypt was a bit of a kind of a moving back and forth, but the fall in India's June gasoline demand came despite Eid festives in June. So it's going to be an interesting one to watch because we do see pressure in some of these Asian markets on an economic basis, on an activity basis. And that's going to leave more light distillate in Singapore storage, which again reverberates back into Fujairah, which is why we aren't bullish light distillates. And that's, globally speaking, there's a lot out there. Now, middle distillate fell 342,000 barrels, and the outlook for Asian low sulfur gas oil market is fairly mixed. And again, it's because you're seeing some pockets of regional growth, but you're seeing a lot of weak global macroeconomic fundamentals, and it's starting to hit some of their ordering levels going forward, where guys are essentially waiting to order. They're in no rush. And that's usually kind of where people start to get a little concerned about some of those flows. So we do think we get some builds It's still going to stay at the low end on storage levels. We're not saying it's not. But as the builds go up, that'll help open some of that east to west flows, and that's going to be an interesting one to pay attention to. Kuwait is going to load 117,000 barrels of low sulfur diesel for export because remember they brought on the Al Zor refiner. That's again going to target that disti cut. And it's been exporting jet fuel, naphtha. Again, back to why there's that naphtha problem. Low sulfur fuel oil. After commissioning the CDU, India's gas oil consumption fell 3.74% on the month, but rose 3% on the year. So again, that kind of cooling of some of that activity. Heavy resid fell 1.04 million. Spot trading activity at the bunker hubs started on a weak note. Again, demand is just so. It's not very good because of, again, the macroeconomic backdrop, the export backdrop. The Asia exports got hit pretty hard. We'll talk more about that in the Econ show when we go through Taiwan, China, South Korea, and how things are shaping up for July. The Brent time spread, we're back in that backwardation. We don't see it getting too much different from this level. As you can see, we'll probably bounce between that, let's call it 30 and 40 as the things kind of balance out in general. Now, when we look at underlying flows here, you can see Norway, small increase, Nigeria, same. Angola came down a bit. Libya so far has seemed to, there was a lot of talk, but so far things seem to be right at just maintaining June levels. Russia is going to be the key one to watch because they started off July pretty strong, and it was that just kind of a strong closeout from June. That's going to be some of the interesting points going forward. West Africa offer levels have gained in the recent weeks that we've been talking about. Forcados was offered at 450, more than dated Brent. And it's likely too expensive, which is why we do see that coming down because it compares with July shipments that was at 275 to 3. So it's like West Africa saw the numbers, some of the tightness, they gunned the numbers and they say, all right, let's start at 450 and then we'll work our way down and see where we cross. It will likely be above $3 given today's backdrop, yes, but it's not 450. And because Nigerian barrels are going to compete with WTI Midland that can be delivered into European hub at much lower prices, which is why U.S. exports, we're not losing exports into Europe. The question is going into Asia. And in order for the lighter barrel coming from West Africa to compete, they're going to have to bring down prices. Dahlia was offered for August loading at 85 cents to 90 cents plus dated Brent, which compares to minus 50 cents in July. Bulk of Nigeria's crude for loading next month remains on offer, while most of Angola's oil for August has been traded already. And again, that's a problem, which is why we think Nigeria is going to start giving some of those bigger discounts, as we showed with those West African builds, that floating storage that has increased. Only 8 to 10 of the 35 Angolan cargoes for August are still available. Again, that's including those being reoffered. Pace of sale is roughly the same as a month ago. Not too much change. Sale of Nigerian cargoes remains slow, with more than 80% of August cargoes still available. And that's where we continue to see some of those pressure points. Loadings of CPC blend crude oil for August are expected to drop to about 1.15 million, with compares to 1.35. The oil field is carrying out some planned maintenance in August, so it's not too different in general. And then when you look at Caspian Pipeline Consortium, that's where we've been talking about. But Erdogan has come out and said Iraq's oil issue between Baghdad and Kurds, the stop in oil exports from northern Iraq to Turkey, is something that originated entirely in a problem between the central administration and northern Iraq. Our position is already to open the pipeline. So again, there's some back and forth, which is why we've been saying the CN is still not open, still keeping some of those different pieces, hindered. When you look at Europe had a bit of a drop in storage, which is, if you look at just timing, is the rate of change. Everything is very normal. Typically, it starts to slow, and then you'll get a bit of a bounce. So right now, there's based on what we're seeing, there's nothing to say it won't. When we look at gas oil inventories, this we already talked about. We didn't get the new numbers yet. Remember, they come out on Thursday, and we did the show on Thursday. So we still expect to see draws from gas oil. As you can see, gasoline still is staying at the highs. We don't see that changing in the gasoline front. The fuel oil side, again, this is that east-west Suez conversation. They're going to start recracking this and blending it in, especially given the levels that they're currently sitting at. When you look at Singapore, again, as we've been saying, we expect to see some of these builds grow. We're likely to see total fuels go back to the 17, 18-year average. Light distillate moving back towards the 22 levels. And then when we look at middle distillate, again, staying at the low end, but trending a little bit higher just based on the demand that we're starting to see. But again, we'll get some of these updates tomorrow with resid, again, trending back to the average. Given what happened with Johan and just some of the spreads with Saudi, everybody essentially turned around and said, well, I'm not buying Saudi, I'm buying Johan, I'm buying everything I can from the North Sea. So it's not surprising to see floating storage go to zero because most of this has now been spoken for. And then when you look at Europe, Europe has dropped as well just because it made sense to make purchases here instead of there. So again, you saw more of this go into motion. That's what we have for you today. If you have any questions, again, please feel free to reach out to us. We covered a lot, especially in this segment, but there's a lot of different moving parts. So just let us know if you have any updates, and we'd love to cover them and hear from you. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.